did have a phone call I actually missed today because I was in a coaching session, because the gentleman had simply asked, can you cover for us today, if you have the time, how you would look to ensure stock positions with the recent run-up that we have. The customer said that he was sitting on 3 or 4 stocks that are showing fairly large gains, unrealized gains, of course, and in addition to the married put additional structure, we may look to buy a new position, use a put option to control risk on the position, limit losses to single digits. How would we look to use the approach in the same fashion with an underlying security that has moved up in price, and we're looking to lock in gains either due to fear of apprehension of volatile markets going forward, earnings dates coming up perhaps, you want to try to lock in some of those gains as you go into earnings and have a no-risk trade on the position, but still want to hold the position. Well, our general approach in the blueprint, of course, on the preferred approach for married put trading, is we're going to buy shares of stock, and at the same time, we're going to buy a put that's far out in time, at least 150 days out in time, and slightly in the money. Now, although the price is expensive, it's going to control our risk down to single digits. Under 10%, typically I want to look for under 8, under 7.5% if possible. Let's just go ahead and do that and look for positions that are only a maximum risk of 8.5%. Now I've got I'm trying to look for ones that I've been looking at recently, and there's one that I like that I'm interested in, Pure Storage. For the Fusion subscribers at Radioactive Trading, I did enter a new married put today on T-Rex, on Trex. We'll take a look at that in a little bit. But I was also looking at 4 other stocks at the time. One of them was Pure Storage. One of them is URBN, Urban Outfitters. And another one was MMYT, which I wish I would have gotten into. And we're probably going to use that for some of our examples going forward. In any case, Pure Storage, currently trading at $42.95. My preferred approach, following the blueprint course, is I may look to buy the August 45 put, roughly $2.05 in the money for a price of $5.80. Well, $2.05 of that is intrinsic value. The remaining $3.85 is extrinsic or time value, and that's my true risk on the position. Purchasing this put, of course, means that at any time during this expiration period, I have the right to force someone to buy my shares of stock at $45. The most I risk is the time value of $3.85, or 7.9% of what I invested into the position. Now, I typically will never hold a position all the way to expiration. And at the same time, I'm going to look to, I'm going to look to do specific adjustments, what we call income methods. There's roughly 13 different income methods discussed in the blueprint. For the most simple, of just selling a call to generate some premium against the position, to manipulating our second working asset in our favor, to continue to lower this risk and potentially bulletproof the trade, meaning I have no risk on the trade going forward, still an unlimited upside profit potential, but a capped floor on the bottom, which started out as single digits, which I'm going to reduce as the stock moves up and down. And eventually I may be able to cancel this risk to have a bulletproof position still with the infinite upside going forward. That's our preferred married put structure. Why am I going 150, 180, 200 days at a time? Why am I buying a put that's in the money, that's more expensive, where I have to pay for that intrinsic value? Well, that's to meet the 3 core principles of radioactive trading, which is really the 3 core principles of any options trade. Now that we've looked at the profit and loss chart, let me just go to the search by symbol tool for our August expiration period. And here we see we've linked to Pure Storage. We kept the same month that came up from the search. Our specific trade is highlighted for us as well. Now, the 3 core principles of radioactive trading, what do we look for when we're considering buying an option? Well, buying an option, entering a credit spread, entering a married put, entering a covered call, the first rule we always want to apply is forcing an ideal size trade, what we call fist. I don't want to overexpose myself no matter how confident I am in any strategy, especially, say, with a credit spread position. I can trade a credit spread on pure storage, bull put, or bear call, depending on my sentiment. NVIDIA, ARM, it's been like a mini rocket ship over the past week or so. But when I enter the credit spread or debit spread position, if the stock doesn't meet my expectations and moves against me, I'm risking 100% of the margin requirement for the credit spread or the debit I paid into the position if the stock falls below both strike prices or rises above both strike prices in the case of a bearish spread. Is that something I want to allocate 85, 90, or 100% of my portfolio to that strategy? Absolutely not, because any adverse market condition, black swan event, could suddenly cause me to be at 90, 95, or 100% loss on that position and wipe out my entire portfolio. So we want to make sure that the monetary risk that we have on this position is only about maybe 1 to 2% of our total portfolio value. So even if this position doesn't work out the way we want, we've limited the risk not only to single digits, following the rules in the blueprint for the particular position. We also make sure this position is not going to cost us more than 2 or 3% of our total portfolio value with controlled risk in place. But number two, when looking at option strategies, comparing where I should buy, where I should sell, and things of that nature, we want to talk about the at-the-money bell curve. You look at any options chain, and we might look one in just a moment, but what you're going to see is the time value of the options is based on a bell curve. With pure storage trading right at $42.95, not shown here, but the 42 and a half strike right at the current stock price for any expiration, 1 week out, 3 weeks out, 4 weeks out, 5 weeks out, is going to have the highest time or the highest extrinsic value. As you go deeper in the money or deeper out of the money, the time value or extrinsic value is going to be lower. If I'm going in the money on the call side, let's say that in this case with the stock at $42.95, I go down to 40 on the call side, well, the price might be $4. But again, $2.95 of that would be intrinsic value, so only $105 would be the time premium. Whereas the $42.50 call and the $45 call, even though it's not a price at $4, the time value being only $105 with the in-the-money call, the at-the-money $42.50 might be priced at $210 or $220, for example. The extrinsic value, the time value is higher. And as I go out of the money, of course, the 45 strike on the call, the 47 strike, they're going to be down to that $1.85 or more as well. Same thing is true with the put options, but reversed. This would be the at-the-money level right here at about 43. You can see it right here for our August series. Our in-the-money 45 put with a controlled risk of 7.9% with a price of $385, all-time value, or the extrinsic value risk of the position. The true cost is $580. But again, that $205 is intrinsic value that we're guaranteed to get back. The $385 is the risk or the extrinsic value. Right at 43, it's $475. That's all time value. It's higher here than it is at 45. And of course, as we go further down in strike, we see the value of the out-of-the-money options are all lowering in price down to 330, 323. That's the at-the-money bell curve in action. We have the lower time value essentially here, and it goes up and then it comes back down. And of course, the third rule of thumb, and this applies for any options trading, is making sure you're forcing an ideal size trade. Let me change this up here. There we go. Perfect. Making sure that you're forcing an ideal size trade. When we look at the at-the-money bell curve again, what does that tell us? When we see that with the in-the-money and out-of-the-money options, it tells us we want to be selling here to maximize the time premium in our favor We want to be buying on the outside wings, which is why we're buying in the money, or the put options for the married put structure. And then the third is the time decay line, or radioactive decay. The time decay of an option is really fast, of course, naturally, in the last 15 to 7 days, starts to skew quickly at 30 days. At about 60 days, you start to see some increase, 90 days here. But out here, it's much more slow. When we're 200, 180, 150, 120, the time decay is really slow. We want to keep that in our favor. So when we're buying, we want to buy on the slower range of the time decay curve. And when we're selling, we want to sell here. That's where we're going to use the income methods in the shorter term. So this is why we're buying in the money puts far out in time, which forces us into the ideal size trade of controlled risk. Are the out of the money options cheaper? The 40 strike, 39 strike? Yeah. Not quite half the cost, but I'm paying $580 up front for this 45 put to control risk to 7.9%, paying $42.95 for the stock. I could buy the August 39 put for only $323. However, in order for that protection to take place, the stock has to fall that $395 down to $39 before the insurance kicks in. I still paid the $323, so the risk goes up to $755, or 6.2%, double the potential loss that I have here with the proper structure in the married put trade. Now, that's just an introduction to the basic structure of the married put and the default search that we see and that we prefer under married put. Oh, I'm sorry, there we go. The basic default there, the radioactive, sorted by earnings per share growth or sorted by percent risk. Now, what does this have to do with the question that came in from the gentleman that called earlier today and said, if possible, with all these stocks moving up in price, can you tell me sort of the criteria you would look for to lock in gains by buying a put option now that the stock has moved up? And to me, the concepts are essentially the same. If I want the best protection on a stock that I have unrealized gain-ins after these large rises that we've seen in some of these securities, I still want to apply those three core principles. I'm already going to be forcing myself into an ideal size trade. But if I'm planning on staying in this position longer, but I'm fearing a market pullback, then I want to apply the other concepts as well. I want to buy the put that's in the money to be paying into the lower time premium, even though I'm paying some intrinsic value, which would help me lock in more unrealized gains. And I want to take advantage of that radioactive decay line so that I have slower time decay on my put option in the shorter term. And also, if you've ever noticed, when you look at an option chain, the option that's 6 months out in time is not 6 times the cost of the 1 month out option at the same strike. The 3 month out option is not 3 times the cost of the 1 month, and the 6 month out option is not double the price of the 3 times. When you go 6, 7, 8 months out in time, you're paying less per day for that particular protection than buying week by week, buying every month out in time, or buying every 2 months or 3 months or 4 months. You get the better cost per day.